Hi, I'm Scott Starratt with Starratt Wealth Management, a part of Canaccord Genuity Wealth Management. So today's chat is going to probably be a short one as we're into the summer doldrums at this point. And really, there's not a lot of activity happening in the markets or in the economy that hasn't already been quite covered in the news already. But one of the things I did want to chat about was how deceptive the market might be today. And what I mean by that is that as you look month after month, and you see this in your statements, that the values keep on going up and up and up every month, that, it would appear as though everything's strong, everything's doing well. But underneath the surface, although the indices themselves continue to hit record highs month after month, the reality is underneath those indices, the individual securities, the individual stocks that make up those indices have been very, very volatile. And what I mean by that is when you look at an index, all an index is a collection of different stocks that when combined together have a price that we follow and say, well, the S&P 500 is up this amount. Well, all that means is that those 500 stocks on average, based on their weighting within the index, is up by that amount. And so one of the things that's happened over the last few months, and I've chatted about this before, where the difference between growth and value, the growth stocks being traditionally things like Amazon and Apple and companies like that versus the value stocks of things like banks and energy and mining, that over the last 10 years, growth has definitely outperformed value by a very significant margin. And a few months ago, we saw that change. We saw values starting to outperform growth. But what we're seeing right now, almost on a day by day basis, or even sometimes an hour by hour basis, is the growth stocks transitioning. In some days that they do very well, but in other days they don't. And some of this has to do with just a reality that a lot of these companies are getting quite expensive, and people wonder how much they can continue to go up. I mean, Amazon, for example, reported their last earnings not that long ago, and Amazon, is doing very well. I mean, they're such a big business, but they're doing very well on things like cloud computing and some of their other divisions. But the one division, delivery to home, was a little bit weaker. Now, still very strong as far as things go, but very weak for what Amazon has done over the last couple of years. And so that got people thinking, well, is this stay-at-home trade, is the fact that we're all getting out and doing more and more in the community, is that going to impact how much we order to Amazon? Because now we can go to the grocery store, we can go to Costco or wherever to buy the goods. We don't have to rely upon Amazon to deliver them to our house. And so that changes day by day. It depends on what's happening with COVID, with this Delta variant or soon to be Delta Plus variant. There's a lot of uncertainty out there. And, although a lot of people do think that vaccinations are a key to eliminating a lot of that uncertainty, we just don't know for sure. And so day by day, hour by hour, sometimes it's energy stocks that do very well, or mining as inflation looks like it's going to pick up. Whereas, like I said, at other times, it looks like we're going to be locked down again, and that the stay-at-home stocks will do much better. So that uncertainty will probably continue throughout the rest of the year. I know I've been beating the drum pretty hard that inflation is probably the biggest risk out there today to the economy, and it appears as though a lot of the inflation that people had said they thought was temporary is in fact temporary. You are starting to see things like lumber prices, used cars, things like that start to drop in value. However, there is still continues to be a lot of demand for employment. A lot of businesses, especially in the hospitality sector and retail, are really having a hard time finding people to work. And so what they're ending up doing is giving signing bonuses or paying them a lot more than they normally would. All of that is inflationary, and it's very difficult, as you can imagine, to cut someone's salary once they've been hired. So the fact that people are getting hired at higher and higher salaries does impact inflation long term. And so that uncertainty is going to continue, I think, throughout the rest of the summer and into the fall. Traditionally, September and October are weaker months for the stock market. Again, we'll see. I mean, that's just the statistical number. We'll see if that's the case. As far as interest rates go, the next few months will be telling as far as what's going to happen with interest rates. The Federal Reserve Board, or the Fed, has their big policy annual meeting in Jackson Hole, Wyoming. That's coming up here at the end of August. And then their next big meeting, the FOMC meeting, is towards the end of September. And the decision will be made as to whether at that time they feel that they can start slowing down on the money printing, slowing down on the purchases that they make of the US government debt and insured mortgages. And so at this point, they're buying $120 billion a month of the bonds and mortgages. The plan is at some point to reduce those purchases. In a normal situation, they would be making no purchases or very, very little. So obviously, 120 billion a month is quite a lot. So they'll eventually have to slow that down. And so the debate is whether in September they actually announce that they are going to slow that down. Now, normally that would lead to interest rate increases sometime in the future. So the normal game plan in the Fed is to reduce the amount of money that they're printing, reducing the quantitative easing that they've been doing for the last year and a half, and eventually move towards increasing interest rates. But it will take them some time, presumably, to reduce the amount of money they're printing, and so therefore interest rates probably will not start to go up, the reading that I've done, until the latter half of 2022. So we still do have some time of these low interest rates. So, if you still have a mortgage, now is probably a good time to lock it in. But for people that, like a lot of our clients who don't have any or a lot of debt, the key is, to invest in safer securities like bonds that are going to provide a really nice income. That's going to continue to be a struggle over the next year or two at least. And, we're continuing to look for ideas out there in the market, and we still find it really, really challenging to find really good ideas that are paying a reasonable rate of return. So overall, we're still continue to be conservative on the market. We still feel that the risk reward isn't right to be, full on into equities, although the economy is doing quite well. The Delta variant or COVID in general, the uncertainty is still there as to whether that will slow down the economy in the fall. Only time will tell. But in the meantime, we'd rather sit on the sidelines and not have a lot of money exposed to the stock market. That's not to say that means we have to sacrifice return, because we're able to find some other investments, especially in their yield bucket, that is able to compensate for that at least somewhat. As far as going forward goes, we're looking forward to starting our in-person reviews now. So definitely for people that are double vaccinated, if you feel comfortable, we're more than happy to Jim and I to meet face to face at your home or at the office here. Obviously, still available to do any reviews over the phone or via online through something like Zoom or some of the other technology. But just when Angela reaches out, she'll ask you your preference. Feel free. We're relatively indifferent. I mean, we'd all like to be sitting around the kitchen table again chatting, but if you're more comfortable just doing, or time-wise, doing things virtually, more than happy to do that going forward. That's about it for now. Like I said, it's been a very stable summer so far. I would expect this stability to continue for some time as far as the returns go. But we're always on the lookout that if there is a spike in fear around COVID, or if any other event happens, whether it be Iran or China or some of the other hotspots in the world, that we are ready to take advantage of those opportunities. But like I said, for right now, we feel those opportunities, we should wait to see an opportunity as opposed to kind of throwing money in at an all-time high. Starratt Wealth Management, we do specialize at helping people achieve their financial goals, successful families. So if you do know of anyone, feel free to pass along our videos to them. Go to our website to look at all of our older videos, as well as some of our educational videos. And if you have any questions, Hangy, Angela, more than happy to answer them on the administrative side, and on the investment side, Jim and myself, more than happy to walk through any questions you have.